Right now, as we look at the tape, Supermicro Inc. is trading at exactly $34.85, showing a push to the upside of roughly 75 cents or 2.2% on the intraday session. On the surface, that green percentage looks like a standard relief rally, perhaps a signal that the bleeding has stopped for one of the most controversial names in the artificial intelligence sector. However, what you are seeing on your screen is not a simple recovery. It is the calm before a binary outcome that will either save this company's equity value or send it into the murky waters of the over-the-counter markets. The expectation right now, the narrative that retail investors are clinging to on forums and social media, is that Supermicro is simply too important to the AI infrastructure build-out to fail. That because they package the H100s and Blackwell chips for NVIDIA, they are immune to the boring administrative death of accounting compliance. The reality, however, is far colder and much more dangerous. The reality is that we are sitting at a deadline that defines the corporate existence of this entity on the Nasdaq exchange, and the smart money is not buying the dip, they are hedging for a potential delisting event that could freeze liquidity in a way that no amount of server rack revenue can fix. To understand why a stock trading at $34 is causing such heartburn for anyone managing an online investment portfolio, we have to look at the mechanics of what is happening today. This is not about whether their liquid cooling technology works. This is about whether they can prove to the regulators that their numbers are real. When you see a stock move 2% on a day like this, it is often a trap for the uninitiated who believe that price action equals truth. Today marks a critical juncture regarding their compliance plan submission to Nasdaq. The expectation was that they would simply hire a new auditor and file the missing 10K report, normalizing the situation. The reality is that finding a major auditor willing to step into a situation where Ernst & Young, one of the Big Four, walked away is incredibly difficult. When an auditor resigns and explicitly states they can no longer rely on management's representations, it is the corporate equivalent of a 5-alarm fire. This is why, if you are looking at your Fidelity brokerage account or checking the charts on your Fidelity mobile app, you might see warnings or heightened margin requirements. The brokerage firms know that the risk here is not just volatility, it is the structural integrity of the listing itself. Let's talk about the price action we have seen over the last few weeks leading up to this $34 level. We have witnessed a capitulation event where the floor simply dropped out, leaving traders staring at red candles that seem to stretch infinitely downward. The volume on these sell-offs has been consistent with institutional abandonment. When you analyze the order flow through platforms like Interactive Brokers, specifically looking at their block trade data, you see that the large lots were not buying the dip during the initial crash. They were exiting. This is a crucial distinction that separates professional capital from the retail enthusiasm we often see on the Robinhood app. While users on Robinhood's stock trading threads were asking if this was the bottom, the data from Interactive Brokers trading desks suggested that the so-called smart money was not willing to catch a falling knife until there was clarity on the accounting probe. This disconnect creates the tension we are seeing today. The price is floating up on lower conviction volume, waiting for news, while the heavyweights are standing on the sidelines with their arms crossed. It is easy to forget, amidst this legal and regulatory chaos, what Supermicro actually does. If you strip away the 10K delays and the auditor resignation, you have a company that was, until recently, the undisputed king of speed in the data center world. Their business model is built on a building block architecture that allows them to assemble high-performance server racks faster than anyone else. When NVIDIA stock began its meteoric rise, Supermicro was the shadow runner, the company that took those precious GPUs and wrapped them in metal and cooling systems so they could actually be used by hyperscalers. Their direct liquid cooling technology is legitimate engineering. It addresses the massive heat output of the new generation of AI chips, a problem that traditional air cooling simply cannot solve efficiently. This is why the expectation was so high. Investors looked at the physical reality of data centers and saw supermicro racks everywhere. They compared it to Apple stock in the early days, thinking this was a hardware play that would dominate for a decade. But here's where the reality checks in. Hardware is a brutal business with thin margins, and unlike Apple, Supermicro does not control an ecosystem. They are an assembler, a very good one, but they face fierce competition from Dell and Hewlett-Packard Enterprise. If Supermicro is paralyzed by accounting scandals, those competitors are not sleeping. They are calling Supermicro's customers and offering them stability, even if it means a slightly slower delivery time. Now, pause for a second. I want you to think about your own position or the position you are thinking of taking. Comment below how many shares of Supermicro Computer you currently hold, or if you sold everything when the auditor news broke. I want to see if the sentiment in the comments matches the price action we are seeing on the tape. Continuing with the analysis, we have to address the role of the individual investor in this specific drama. We are seeing a massive divergence in behavior across different investing sites. On one hand, you have the passive money. If you're using something like Schwab Intelligent Portfolios, your exposure to SMCI might have been automatically trimmed as the volatility spiked and the market cap shrank. These robo-advisors and automated systems are designed to manage risk, and a stock that loses half its value in a short period triggers rebalancing algorithms that sell into the weakness. This creates a mechanized selling pressure that has nothing to do with human sentiment and everything to do with risk metrics. On the other hand, you have the active traders on SoFi Invest and the Robinhood app who are looking at the $34 price tag and seeing a lottery ticket. They argue that the company is profitable, that the revenue is real, and that this is all just paperwork. This is the value trap argument. It relies on the idea that the market is inefficient and has overreacted. But in the world of forensic accounting, where revenue recognition issues can force restatements that wipe out years of perceived profits, the market is often reacting to the unknown rather than the known. The relationship with NVIDIA is the single most important external factor here. We mentioned NVIDIA's stock earlier, but we need to look deeper at that supply chain link. NVIDIA needs its chips to get to customers. If Supermicro cannot obtain financing because they don't have audited financials, a very real risk, as banks often require signed 10Ks to keep credit revolvers open, then they can't buy the inventory they need to build the racks. It becomes a liquidity crunch. If they can't buy the chips, NVIDIA will allocate those chips to Dell or other partners. The demand for AI compute is so high that NVIDIA can't afford to have inventory sitting in a warehouse waiting for Supermicro to sort out their accounting. This is the spiral that bears are betting on. It's not just that the stock gets delisted, it's that the business grinds to a halt because capital dries up. This is the nightmare scenario that makes the current price of $34 look expensive to some fundamental analysts who focus on balance sheet health over income statement growth. However, we must look at the bullish case to be balanced, because if the reality turns out to be less catastrophic than the fear, the upside is violent. If Supermicro announces tomorrow that they have retained a new top-tier auditor and that the Nasdaq has granted them the full 180-day extension to file their reports, this stock reprices instantly. The short interest in this name is crowded. A piece of legitimate good news could trigger a squeeze that sends the stock vertical, punishing anyone who got too greedy on the short side. This is the scenario that keeps the price hovering here rather than going to zero. It's the option value of survival. Traders using the interactive brokers platform to sell puts are essentially betting on this outcome, that the company is messy but not fraudulent. They are collecting premiums on the fear, betting that the business is real enough to survive the audit process. It's a high-stakes game of chicken with the regulators. We also need to consider the broader context of online investing today. The tools available to you, whether it's the research tabs on your Fidelity Investments account or the social sentiment indicators on SoFi, give you access to more data than ever before. But in a situation like this, data is secondary to trust. When trust is broken between a public company and the capital markets, the repair process is long and painful. Even if they survive this, the valuation discount will persist.